Welcome to the daily Forex trading strategy session. It is Thursday, the 28th of January, 2016. Oil's going up. That's a good sign, huh? Sweet. Let's do some trading, huh? Yep. What? Can I get a Hey, yeah, let's do this first. Trading's risky, not appropriate for everyone. Your past performance is not indicative of future results. Don't risk money you cannot afford to lose. My name is Wayne McDonell. I'm the Chief FX Market Strategist for TradersWay.com. We give you access to Forex and energies, metals, and all those wonderful things. We'll even cover global equities today. But at the end of the day, we do it without drama. We pass your trades into the interbanking system quick and easy without any stress. And at a fair, reasonable price. Isn't that what you need? A partner that is truly a partner with you. My name is Wayne McDonell, and I love trading currencies. What can I say? I hope you do too. These events are live at Forex.Today, Monday through Thursdays. Swing on by. There's also lots of analysis on the website by our trading team that posts their trading ideas. Swing on by, read a few, but please leave a comment. Would you do that? Would you volunteer to leave a comment on one of the posts for today? You know, if you think about it, it's someone time to do the research, to look at charts and think about it, and then they got to take screenshots and save the files, and then they have to write it all out and put it and save it. And oh, it doesn't look quite right. Add a space here, change a line there, bold this, change the font, and then post it. You know, I mean, it takes a real person, real time. At least leave a comment, right? Kenny says, what happened last night? Question mark. Yeah, what are you talking about? Cool. All right. Yeah, so let's play the happy music and then go on to the trading. No show? You mean I did... we traded the Fed news report, and then we traded the Kiwi news report, and I made 100 pips. Yeah, weird. Huh, well, the video's on YouTube. Here, let me play the happy music and find the video for you. Okay, do you see YouTube? Yeah. Right there, 100 pip live Forex trade, Fed and Kiwi news trading, live stream recording. 16 hours ago. I'll just keep going. So, by the way, my name is Wayne McDonell. I'm the Chief FX Market Strategist. Yeah, so we did it, recorded it, posted it. Oh, too bad, man. How do you know there was lots of people, Ryan? I'm just interested because I've never really done it before, so there was a chat, huh? Huh. Strange. How many people do you think there was? 50? 150? Yeah, around 50. Yeah. All right, well, we'll figure that out, right? All right, let's get going. Oil on the left, West Texas Intermediate. And if you recall, we put a little floor on this to 3A2. And there is an hourly 21, but it was down here at that time. And really, the first part of this is like price action. You would, just like any other scenario, you would start at the top here. But really, anything between the 3A2 and 618 is really traditionally fair game if you're a trend trader using price action. Okay. And so you had that move in Asia, moved up in London. So, on our way to 33. All right, not huge, right? A buck, but a dollar is a dollar. Yeah, so you guys said there was 20 to 50. Well, there was over 100 people in the actual event I held. So that's interesting. So we'll figure that out. It looks like add them all together, there was probably closer to 200 because you can imagine not everyone hung out to chat in an empty webinar room, right? So we'll figure out YouTube. It's a bit clunky technology, but anyways. So oil going up, that's a bit of a risk, risk on scenario maybe, perhaps. But isn't that interesting here? This is going the wrong way. Noki is going the wrong way. Okay, so one of these is lying. You liar. You're a liar. So maybe something else is going on with Noki. Let's go over to KittyCAD. Meow. I guess how would you read this? Oil is riding the 21 on the hourly, making higher highs and higher lows and higher highs and higher lows and higher highs. And USD CAD is more consolidation, right? It looks like the 21 really isn't in control. The 55 is in control, as you can see in here. Now, when the 55 is in control, what's your expectation for the move? If the 55 is in control, and you can see it is here, right? 21 was trying to hang on here, made a move, rocketed it back up. Now the 55 is in control. 21's dead. When the 55 is in control, and it kind of looks like this is, especially if we get red candles here, then what you're going to see is then this EMA, which is lagging, is going to come down and hit the top, just like this one. So that would lead to a downward move, but only to about here. Okay, so a huge Hail Mary guess here would be, more like this at some point. And that means oil would do something like this. Okay, Ryan wants me to clarify the market. Okay, so this is basic market movement theory, right? 5A cross, price, not market, price turns down. Okay, but price can fall in a rising market. We know that. But right there, technically, price, only price, has turned bearish. Here, on the 2155 cross, the market has turned bearish. And it's moving very quickly, and you can see it makes a low, and we really got to zoom in here. Makes a low, retraces, lower high, hits the 5, drops. New low, retraces back to the 5, drops. There's the new low, retraces back to the 5, drops. 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 What moving average seems to be in control of the price? That's called Ride the 5. That's the name of my yacht, by the way. Ride the 5. Okay. Then the market wants to slow down, retrace, mostly on profit taking, right? So you can see down comes to a cycle level, right? Midpoint cycle level. So lots of people start to take profit. Great. So if these bears wanted to trade again, where would they do it? You measure it with a Fibonacci retracement and somewhere around, I don't know, the 382. But if you're not using Fibonacci, if you're just using price action, or sorry, moving averages, the next moving average to sell at is the 21. That is why it's there. Leon wants to see the daily. Yeah, just click on D1. It all works the same. All right. So your job, the reason we have the 21 EMA there, is to sell it at the 21. When the 21 is in control, now remember the 5 used to be in control, but things are slowing down, but that is still a very awesome, very confident trade to sell it off the 21. Okay, you're bearish, you're confident, right? There's nothing in the world that can make you buy this. And it's supposed to make a lower low. Now it didn't make much of a lower low, but something changed. There was a lot of fundamental news this week. Okay? But that's it. That's the 21 is now in control. Well, once that failed, guess what? We breached and came all the way back. Now really it's a range trade, isn't it? So how would you mark it up if it's range trading? If you have this as a top, how would you mark the bottom? I don't know, kind of like this. Because this area hasn't happened yet, right? Because we're talking about it in here. So, right? And we've had a chance to make lower lows, and it was pretty lame. So what's likely to happen? Well, we test this area, holds again. This time we're going to breach this area, come back, and head up to the 200 EMA, which is fair market value. So 5 is in control, 21's in control, 55's in control, right? Reset at the 200. Okay. Right, so now you're watching this like this is a 2155 cross. No. What are the market conditions here? Trending sideways. When you're in a range, you trade differently. Why would you use your moving averages? Let me ask you something. The 2155 represents market, right? Well, if we're moving sideways, is the market bullish or bearish? It's neither. So there's no market. Who cares about your stupid 2155? There's no market. The 2155 measures the speed and direction of the market. What market? We're in a range. There is no market. And there's only ups and downs. That's called price. Price has nothing to do with market. So you have to change your strategy. And that's why I say, oh, vey, that wasn't much of a low, right? So I'm immediately going to go whoop, whoop, whoop. And then it doesn't make a high, and I'm going to go whoop. We're in a range. Change strategies completely. Buy at the bottom, sell at the top. And I'm also assuming a break. I'm assuming because we didn't break low that eventually we're going to break up, okay? And I would be long and strong right here. And then we'll be riding the 5 this way. And then the moving averages will cross up, later a little higher than that. But anyways, and maybe we get something like that. Okay? And for that to happen, this needs to go down, and that's exactly why we're looking at these together. How does that make you feel inside? All tingly and stuff? It's cool, right? Yeah. Yipper. Right? So very basic questions. One, are you a bull or a bear? It may not be on this chart. Who cares? What does this chart have to do with anything? Are you a bull or a bear on oil? It's not a chart question. Right? I love you too, Alan. You domain. All right? Bull or bear? That's it. Make a decision. It's a fundamental decision, really. But if you can't do the fundamentals, at least move this to a daily or a weekly or something and make a decision, right? Whatever. And then number two, let's say you're a bull. I don't know, whatever. You're a bull. Okay? Now you go to your chart and you say, is the market bullish? And if so, how quickly is it moving in that direction? These are important questions, aren't they? Are you a bull or a bear? Right? And is the market agree with you? And if so, how quickly is it moving in that direction? How could you possibly trade without solid answers on that? How do you know if it's going to move 20 pips or 200 pips? Without answering those questions, I bet you can't. And every time you pull the trigger, you're just like, hope this sucker moves, but I really don't know. Right? Well, being able to answer those questions is what it's all about. So the way I came up with the 2155 and the 58 is very early on I realized there's a difference between price action and market forces. So I need a way to separate the two. So how about this? If I recognize the market is bearish and actually falling fairly quickly, then my job is to catch price when it's overpriced, at resistance, and just beginning to fall in the direction of the overall market. And guess how well I did when I started doing that versus just throwing down trades and hoping? Suddenly I'm only selling in falling markets when price is overbought. When somebody is screwed up and pushed price up in a falling market. Well, if someone else screwed up, I have to take advantage of that. That's the whole game. I'm the one that reprices so that the market is appropriate. And that's called trend trading, really. If someone else screwed up and bought in a falling market, it's not my fault, but I'm going to sell at resistance and I'm going to win. It's just, that's it. What else is there, right? And so, therefore, we need that type of information. Don't you know? Okay. Gino says, which time frame do you prefer doing this analysis? Okay. I like to start on the daily, and for some reason, my daily's not fitting in there anymore. Hello. Kind of funny. All right, well, let's do it this way. I like to start on the daily. Now, a lot of people like weekly. Let me tell you my thoughts on that. You're probably like, why do I need to tell you my thoughts? My wife loves to tell me I'm very opinionated. I have strong opinions. I'm like, yeah. Yeah, really? Yeah, it's a good thing, right? I guess. Well, yeah. But anyways, I don't like going to weekly because I'm a fundamental trader. First and foremost, that's where the ideas come from. Okay? And the fundamentals could have changed drastically since here. Okay? But your technicals would say nothing's changed. Well, what if everything's changed? The Fed's not going to raise interest rates. The ECB is only thinking about more quantitative easing. Japan's going to come out and say there's no way we're in a situation where we're going to add quantitative easing, right? That's going to happen in just a few hours. How could they do quantitative easing when the economic minister just was fired? Did you guys catch that today? Wow, sorry. Amari resigned today. Abe, right? You have Abe, Kuruda, and Amari. Well, Amari's gone, dude. Boop, boop. Yeah, Ryan's like an hour or two ago. Well, I don't know. I like to keep in touch, right? So if you're not in line with Japanese politics, so anyways, so what? So maybe everything's different here. If this was like pound dollar, let's say, and versus WTI, I don't really care. I'm just looking at it as a chart. Okay. If you're only a technical trader, you might say, well, I'm going to trade this the same way I traded this, the way that I traded this, the way I traded this. But a fundamentalist might say, well, a lot changed here, right? We had the Fed, right? We had the ECB. We're pretty sure on the BOJ, so on and so forth, right? And you could, and I'm not saying this is changed. I'm just saying it may have. But if you're just like, I'm going to do something because I see a line on the weekly chart. I'm like, well, okay, you're potentially omitting a lot of information. Okay? So I like to stay on the daily, if you don't mind, because, I basically look at it week by week, month by month in my mind, right? So very often you hear me say, well, up for the rest of the week and down all next week. Right? I was mentoring someone yesterday and we were looking at something and I said, well, let me go through the price action. And I said, down for a day, up for a week, down for a month. No joke. He's like, what? I'm like, yeah. Look, watch. Down for a day, up for a week, down for a month. There you go. Any questions? All right, so that's kind of how I use the daily, and I can fold in, I can fold in some fundamentals, I can fold in some technicals. It gives me a pretty long-term view of things. Like this is basically the whole year, right? Whatever. It gives me enough time frame, but I can adjust for fundamental changes. Okay. So that's where I start. And I start this analysis. Now, let's go back to the conversation then. Which moving average is in control? Okay, 21.55 cross. Technically, the market's bearish here. New lower low. What do you do? What does Wayne teach you? Do you guys remember hammock? Why have I drawn all these little gray boxes? Why does Wayne do that? Well, let's do it right now. When we're down here, okay, you don't do this until we're down here, and you say, oh, we've made a new lower low, okay? That's when I do this next step. I say new lower low, drag this old support across, and it's my new sell zone. But where is the 21 EMA at that time? It's the same thing, right? I pity the fool. So anyways, so price comes up and sell. Yeah, but look, it had to rise for almost a week. Yeah, so what? Oh, well, that made me bullish. Yeah, well, I pity the fool, right? So if you didn't know we were here, How do you know over the course of all these days, look at all these days here, whether you should be short or long? And if you sold here and you're at break even, how do you know whether you should take 25 pips or 250 pips? How do you make that decision without this information? You see what I mean? This is why amateur traders just can't do it. It's just not a game they're going to win on the long run because they don't have this crucial information. What's the direction of the trend? What moving average is in control? How fast is it going? And then you know, look where it ends up stopping, right? Like monthly pivot points. Oh, but I don't use monthly pivot points. Well, you know, how do you be successful then? I don't know, right? But you see the power of all of this? So like 2 days ago or something, we were testing this 21 EMA on the daily, and this is oil, right? Is it important? Yes, it's very important. Did it hold? Well, it doesn't look like it held, but let me zoom in. Look what happened when we tested it. Were there bears there? Holy smokes. Yeah. Very important, right? Now, did it work out? No. Is this possibly a change of trend on this time frame? Well, no. On a smaller time frame, for this type of thing, that would be a change of trend. But the actual trend is this, isn't it? This is the one we should be worried about on the daily. So how does this play out on a hourly chart? Higher high, higher low, higher high. Then what's going to happen? Let's predict the future at this 55 EMA. Are you ready? If technical analysis does this, now we're actually looking at WTI. There's very little technical analysis really going on here. This is all emotion. But anyways, let's just do the analysis part. Okay, we retrace up. Maybe you need a three-wave retrace, whatever. And you get yourself up to this area, which you've marked already, right? You've already done this part. I'm sure you have. Okay, so now we're up there. How long is that going to take? 3 more days? What is it, Thursday, Friday? So there we are, Monday. London Open. What's going to happen? I'm going to look to sell, sell, sell. What's the target? Lowest low, thank you. Why? The 55 is in control and predicts a double bottom. We just saw this somewhere else, didn't we? How long is it going to take to get down there? 1, 2, 3, 4, 5, 6, 2 trading weeks. So here we are, Valentine's Day. And then what? Up to this 200, which will come down. So we're going to go back to $28 a barrel and then up to 40. Oh, snap. How long is that going to take? So down here, $28 a barrel, Valentine's Day, and then April 1st, we're at $40 a barrel. Isn't this easy? Right? Stop me. Okay, that's how you do it. So now you have your general strategy, right? So now you go into your smaller time frames like 4 hours and hourlies. And so now this is where you can get things like, well, we know we're going to go up to that other level, so therefore we're going to need higher highs and higher lows to get there. And then we're going to get there, and then we're going to eventually make some sort of reversal. Then we're going to go down to 28, and then when we get to 28, it's going to do some sort of reversal. And then it's going to go to 40, and which means we're going to have those types of price actions, and those will have to have little fib retracements and whatever. You just put it all together. So let me just put some wild things into perspective, okay? Just in case some of these things seem crazy. By the way, I do this stuff many times over the past, and you know what happens is you don't pay attention. 6 months later, we come back and it did it. Things like, you know, I've predicted many times currency pairs moving 3,000 or 4,000 pips, and it's done it. But I want you to look at this for a second, and we'll even go weekly here. Okay. What's the top? What's in the range of possibilities for this? Okay. Have you thought about it? What's too far? 150? $160? Right? How about 2.0? Yeah, well, that's not good for Canada, right? It's plausible. Okay? If oil stays low, by the way, there's a secret meeting going on today. You guys know about it? Saudi Arabia and Russia getting together? Do you think these guys like each other? Saudi Arabia and Russia, all right? A Saudi and a Russian sitting in a bar? Yeah, they hate each other. Here's why. Saudi Arabia will say, all right, let's cut oil productions and stable prices. And Russia says, yeah. And then just dumps more oil on the market. Yeah, here's the thing. Russia has been dead broke for about 40 years. And the only thing keeping Russians alive, like literally putting food on the table, is oil. And they don't really care whether it's $100 a barrel. If it is, then you do things like, you know, invade the Ukraine. Because you're like, oh man, we got money, and there's some nat gas there, and there's some distribution things. Yeah, let's go in and take it. And then, at $25 a barrel, Russians are literally going to starve. And if that's the only source of money, they don't really care if it's $25 a barrel or $35. What they say is, we need $500 million this month, pump the oil. It just comes down to pump more oil. Just like we need the 500 million. If you have to do a bajillion barrels, if you have to ramp up production by 500%, just do it. All we care about is having the hard currency. That's it. Now, if oil is $50 a barrel, they only have to pump out half as much. But it's not a function of how much. It's a function of how much money is needed. Literally, Russians will starve. And then what happens when the population starves? Riots in the street, political unrest, Putin gone. Well, that ain't going to happen. So what are they going to do? Pump, 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 pump. And then let's say they drive oil prices to $60 a barrel. Let's say they actually work out their cultural differences and their competitive, nature, because they're both are, produced oil. So let's say they can actually agree. Push oil back to $60 a barrel. Then what? The Americans come in and just frack it. Like the video the other day was called, "What the frack is up with oil?" They just frack some more oil. oil prices come back down again, right? Holy smokes. Don't even get me started with Azerbaijan. They're in some serious problems. How about Venezuela? You guys reading about Venezuela? You know what they need because of their debt? Do you know what they need oil prices to be? They pump 2.5 million barrels a day. That's a lot of oil, guys. You know what their break-even point is because of their debt? 120. Oh, no. Venezuela! What's up, Venezuela? A little whoop, whoop, whoop. Right? Holy smokes. Yeah, that's going to be a while. I think maybe in 15 years you can go and buy some nice real estate in Venezuela for cheap. Holy smokes. What is going to happen, huh? Yeah, no more Miss Universe pageants. So anyways, so how about this? I'm just thinking out loud here. I'm not making any predictions. But if oil stays low for a very long time, what's going to happen to the Canadian dollar? I don't know. I mean, I don't know. This is why we're here, guys. And, we're talking now 5 and 10 years, right? Now, let me ask you this. Do you think eventually global demand will improve? Let's say over the next 5 years. Right, Charles brings it up. We were talking about this actually yesterday in yesterday's webinar, but you have, demand curves and you have supply curves, right? And so let's say, so this is price, right? Here's your price. All right, so let's say now, let me label that. You always have to label the charts. Okay. Supply falls, right? What happens to price? Price goes up. If supply increases, what happens to price? Price falls. So this is P2. This is P1. Or we'll just, P1, and then this is equilibrium price. So what happens is prices either rise or fall according to how much supply, right? But then if you shift the demand, more demand moves this equilibrium price from here to here, and now we got P3. Right? Demand falls, equilibrium point moves here, price is now P4. So we're constantly finding equilibrium prices, right? But the thing is, I think supply is going to always be abundant now for the next 5 to 10 years, let's say. I don't want to think any farther than that because that's just silly. But I think we're going to have lots of supply. I don't think we're going to have a shortage anytime soon. So the only thing that could move, and let's change my color here. Tool color, let's do red. Okay. So I think the only thing that can, let's keep supply constant. So I think the only thing that can change is like this. Let's say demand is as low as it's going to be, and the only potential here is for demand to shift to the right, and the equilibrium point moves up a bit. So likely outcome is, I'll make it P5. Likely outcome is higher than 30, but lower than 60. Any economists here? Anyone take a lot of economics classes? Do you get all giddy when you see supply and demand charts and models? Yeah. Zzz. And then we can get into debates like, oh, well, what's the slope of the demand curve? Oh, well, shut your mouth. Teacher's pet. How do you get, Horace, how do you get a moving average on your chart? Okay, you go insert, indicator, and boy, I haven't done this in a million years. Moving average. Okay, change the color, change the period, change the thickness, hit OK. Rinse and repeat. Boom, 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 boom. Wow. You guys having a good day today? Yeah? Cool. Right on. So that's that. That's a lot. We've talked about a lot. You want to do Eurodisty? I guess you kind of have to, right? It's required by law. So let's go to, we'll do the 4 hour. All right. So the message has been that there's no reason for dollar to be strong, and there's no reason for euro to be weak. That's the message for the last, what, 4 or 5 days? And the reason for it is I had guessed that the Fed was going to be a little more dovish. Right? And that, so if they're not going to raise interest rates, there's no reason for the dollar to get stronger than it already is. In fact, some dollar strength could occur because people thought the Fed was going to raise interest rates. Okay? And then the second part of this equation is Draghi and his team have talking about adjusting policy at the next meeting. They talked about talking about it. So they're like, yeah, next meeting, let's talk about it. So they talked about talking about it in the future. And how far does it take a European, I mean, how much talking and cigarettes do they have to go through before they actually do something? You know, if they're French, I mean, he's Italian, right? So if he's French, they'd have to strike for a few days first. Drink some red wine, have a package of cigarettes, and then strike. And then go on holiday, strike again, and then finally do something. Right? And, you know, an Italian, I don't know, they do something similar, they just look better. So, I don't know. Talking, I suppose, is the beginning, but that doesn't necessarily mean action, does it? You bribe them. Now. I don't like cultural stereotypes. All right? I'm Canadian, so the cultural stereotype is I'm kind, I'm smart, I'm beautiful. And that's just a coincidence. But not all Canadians are like that. Most are, but not all. Yeah. So anyways, you know, talking about maybe adjusting policy doesn't necessarily mean they're going to do it anytime soon, right? Talking about it could mean September for all I know. Henrik says, yeah. Well, South Africans and Canadians, you know. Yeah, like if you go, let's say you're backpacking through Nepal, who are you going to run into? A Canadian, right? Someone from South Africa, someone from New Zealand. And the three of them are backpacking. Yeah. There you go. Yeah. Yeah. So anyways, so if Draghi, let's say if or maybe he doesn't do a policy change soon, then is there any reason the euro needs to get weaker soon? What's the catalyst, right? You see what I mean? Okay? So that's all I'm thinking is, you know, there's fuel, but there's no match. All right, so talk to me when you got a match or a lighter, and then we'll talk, right? So if they did change their policy and add to quantitative easing, what would happen? Euro would weaken. If the Fed did raise interest rates at the next meeting, what would happen? Dollar would get strong. Neither of those things seem to be happening, or at least today, it's not on our minds. So therefore, the opposite of Euro USD going down is Euro USD going up. Now, in a scenario like that, I think what happens is it slowly goes up and then quickly comes down. Okay? So here's the problem though. This is where amateurs end up losing a lot of money. You made a lot of money recently on Euro USD. And then if you get caught in scenarios like this, what happens is you just keep shorting, keep shorting. Well, Wayne said Euro USD down. Oh, look at the interest rate differential. Oh, yeah, look at the central banking policy divergence, right? The divergence in central banking policy. So, but whoa. On the 4 hour, the 21 is above the 55. We're riding the 21. Holy smokes, eh? So you can't be so simple, right? There's more to it than that. There's timing. And you can get in a period of 2 or 3 months of lull in Forex, and you can give up, you can lose a lot of money and all that kind of stuff. And what you should be doing as a professional, like we were talking about earlier, is that you should take like a multi-year view of your trading and not be so in the moment all the time. And you should realize, like, hey, we're taking a pause. We didn't get much action out of either central banks. The market was heavily net short based on previous changes in policy. So we're not going to really have an opportunity for a policy change now until March. So maybe this isn't so aggressively bearish until maybe the March meetings. And even then, we're going to need the Fed to raise interest rates. And we're going to need Draghi to at least hint or even tell us that at some future meeting they're going to raise interest, or they're going to raise quantitative easing. Right? Because isn't that their course? Isn't that what they've done in the past? All right, we've talked about it. We decided in September we're going to add to quantitative easing. Like, oh snap! Well, why would you wait? But whatever. That's their thing, right? House is on fire. We have a bucket of water, but we're going to wait a little bit. So it could be a while, right? So we need those policy changes. At the end of the year, could the euro dollar be lower than this? Oh yeah, almost certainly. Okay. Now, if let's say the Fed raises less than people expected, maybe only twice this year instead of 4 times, the dollar won't be as strong as we thought last year or the year before, right? Now, what about the ECB? What if they never add to quantitative easing in 2016? Talk to me, Goose. What's the result? Talk to me about money. Euro will go much higher. And the reason for this is foreign investors and foreign companies will face less exchange rate risk. Yet we're in a period of quantitative easing that's been priced in. We see that at 108 or 107 or 106. It's been priced in. And suddenly it becomes apparent that the ECB is not going to add more quantitative easing. We're not worried about Greece and Italy and Spain and Portugal and all these things anymore. That's all been kind of dealt with. The banks have been recapitalized, so a lot of that risk is gone. And companies say, well, now that we don't have sort of the geopolitical risk, and now that we're facing a lot less exchange rate risk because we've already, the QE has already been priced in and we don't seem to be getting additional QE, then why don't we go into Poland? No, well, I guess we can't go to Poland, but why can't we go to Germany and buy some German businesses? Why can't we go to France and buy some French businesses? Because now we're not so worried about the exchange rate. And why don't we start going in buying up some deals at the bottom? You see what I mean? Because on a 30-year outlook, this is probably a pretty good time to buy European companies, right? Go buy a medium-sized German company. Let me give you an example. There's a small company that's been around for 4 years. They got some venture capital, and they bought a 100-year-old German business. Because the German business was doing their business, but their market has been sour because of obvious reasons. It's a good company. They have the machinery. They have the equipment, right? The equipment and the people and the talent, all that kind of stuff. But liquidity, right? They were short on cash. It's been a tough 8 years. Even for a 100-year-old company, suddenly they're like, wow, we have a good product and we have a good team. We have good equipment. We have assets. We just don't have any cash. We've slowly depleted it. So this 4-year-old company with venture capital just walked right in, said, oh, well, what if we gave you $100 million? Can we buy you? And they're like, what? How about 105 million? All right, 105 million, done. So would you spend $105 million if you were worried about the value of the euro dropping by another 30 or 40%? See, that's what I'm talking about, Kenny. QE is already priced in. How long have we been at 105? You see what I mean? We've priced all this in, and we've come down to 5, and then we went up to 15, and then we came down to 8, and now we're going back up again. There's not much ammunition right now to make the euro go to parity or below. Okay? So if we find out Draghi's never going to do more quantitative easing, well, the quantitative easing they're already doing has been priced in at the prices we're at now. So if suddenly you were a long-term investor, like a corporate investor, and you want to buy something, and you say, well, all these other risks, these external risks have seemed to dissipated and are manageable and priced in, and now quantitative easing has basically been priced in, and now all the the risks have been identified and priced. So now you can go in, maximum US dollars strength, not likely additional weakness on the other end, all the other risks basically mitigated and priced into the lower price, because for all we know, the company 10 years ago could have been a $1 billion company. Now an American is buying it for $100 million. So who knows, right? So now, for some, it might be an opportunity to go in and buy, and that drives the stock market up, which is what quantitative easing is supposed to do, so on and so forth. And yeah, over that period, then we go all the way back to 140. Not quickly, but that's money, isn't it? And I'm trying to boil it back down to the basics. If Draghi's not going to do something to weaken the euro, and if Yellen doesn't do something to strengthen the dollar, then it's already been priced in, this move. But I do know Yellen will raise interest rates again, and Euro USD will come down again. But is this going to go up to 115 or 120 and then come down? Well, the next meeting's a long ways away. And have you checked the Fed funds rate? So you got to watch this almost daily, guys. This will tell you if the dollar's going up or if the dollar's going down. Okay, next meeting is March 16th. 30% chance, 29% chance they're going to raise interest rates. Remember, the January meeting was like 11. Okay? April, nothing happens. So June, 50%. So if that happens in March and in June, dollar gets strong. And if somewhere in there, Draghi adds to quantitative easing, euro gets weak, and then we're Oscar Mike, right? We're on the move. Roger that. Euro USD, Oscar Mike. Thank you, Overlord. Okay. Interesting, right? Remember, this isn't just a game. It's not just colors on a chart. It's money. Money, 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 money. What will drive investors? What will drive traders? What will drive business? What will drive trade? That's what's important, isn't it? So I hope you like the stuff like this. Good talk. So once again, the message we've been talking about for several days now is there's no real reason for the euro to be weak, and there's no real reason for the dollar to be strong. And this has been going up like a rocket ship ever since. Okay. Kiwi? That was so yesterday, though. Okay. Okay. So in yesterday's webinar, I was on Kiwi Yen, but I sold at the very top and got out, with 100 pips. It's hard to do a webinar and have like 9,000 charts flickering on and off. So anyway, so I took the pips. What was the motivation for what? Oh, Nancy, I talked about it like even a day before. Sold at resistance. I gave like 3 or 4 reasons why there was no way you'd want to be long Kiwi. Right? And that I expect the Bank of Japan to disappoint today. So yeah, I talked about it 2 or 3 days in advance. There was multiple reasons. So like with Kiwi, let me just give you one, right? The Department of Agriculture predicts a drop in milk prices by 6%. By the way, like, I'm not joking, like 10 minutes before this Kiwi news came out, Fonterra, the auction company that handles all the dairy auctions, they cut their forecast for 2016 dairy prices 10 minutes before the announcement. So there's just like so many reasons that, to be short this. And I waited to be at like resistance. I wasn't on this pair though. I was on yen, but it was the same sort of idea, right? And then on the BOJ side, which is tonight, many market participants have been guessing that the Bank of Japan is going to announce additional quantitative easing. And that's not going to happen. And so additional quantitative easing would make a pair like, let's say, Kiwi Yen go up. If that ain't going to happen, then the pair would go down. You'd get yen strength on disappointment because the Japanese stock market will fall, which means the Japanese yen will get strong, and this pair heads down. So, there may be another trade setting up here for tonight. Right? So that I'll show you here. You can watch the video though. You can clearly see my trade. And when the news came out, my stop was already at break even. I mean, it was just nothing. Yeah, Mark. But again, that's what I said multiple days ago, and that you should get ready. Yeah, I was short. No joke. Like drop, pullback. Yeah, I was short here. Actually, that's right. Yeah, 77.50. This is 77.53. I think it was 77.51. So 2 pips off of that, but you get the idea, right? And I was in a webinar, and so I decided to just get out around support, I think it was. But pretty straightforward stuff. Now you can see, let me move this to like a 15-minute chart and then zoom in. You can see I have all the price action. So in the webinar, I'm not going to be able to fit this in. In the webinar, you can actually see what happened was it dropped. I drew the fib. Do you guys see the fib study? Which means somewhere between the 382 and 618 you sell. It came up exactly to the pip, 50%. Okay? And if you know what that means you sell right here. I even drew it before it happened. Go watch the video. Before it even happened, I drew this fib retracement and this drop. Then I said it would come back here and then drop again, and our target was here. Before it happened. On multiple time frames. And then what did it do? It dropped, hit support, made the 50% retracement, dropped, and I thought perhaps it would, retracing. Oh, I was wrong there. It just went straight down. Sorry. Hit the weekly central pivot and stopped. So I think the ultimate move was 150 pips. So I was wrong in that retracement, but sorry, right? So, but the trade plan, the clear trade plan was to sell here for at least 100 pips. Okay, interesting. So, again, who was it asking? What was the reason for it? I gave multiple reasons for it days in advance, and I think if you watch the webinar again, I think I really clearly for like 20 minutes talk about all the different reasons why we need to be short this, and then the news came out and 100 to 150 pips in the pocket. Am I right? Yeah, pound, huh? We can do Beast here. Beast has had some nice setups as of late, but I'm worried about today's Asian session. Okay, so I'm optimistic but cautious. Okay, the nice moves here are like up, the little retracement. That's a buy zone. Oops, I meant to do this. Okay, little buy zone. Up. Okay, range trade. Right, and then this is a 618, or not. It's actually 50%, but you have it like this kind of thing. So the next plan could be, like this on a small time frame. But at some point, you have to recognize that even though we've been short this dirty dog for a long time, that things are starting to set up. You know, it looks like we're climbing a ladder, doesn't it? Well, the GDP thing was only preliminary, right? We talked about that on Monday. It's advanced preliminary, 90% chance there's going to be a huge revision. So I don't know if they've calculated everything in that number, but they hedge it right off the bat by calling it advanced preliminary GDP. Okay. You know what? I'm going to go. It's been an hour and 15 minutes. That's a lot of news. So I'll be at FX Street tomorrow. Thank you. I will upload this video to YouTube. It will be there in about a half an hour. Once again, I hope you promised. I think you promised that you're going to go to Forex.Today and find at least one post where you're going to leave a comment. Is that right? You're going to leave a comment? That's it? Only a comment? That's all that's being asked? That would be really cool. So peace on earth. May the pips be with you. May your profits be above average.